You just for the period that you've known me, um, I've actually, how do I put this? I'm actually big on direction rather than chart pattern. Now, the building block system, especially for those who are conversant with a trend line strategy, a trend line system, is very. So let me continue. Okay, good. Two is enough. Oh, okay, that's better. Thank you so much. Now, let me proceed. Now, this is already an opportunity where someone would have entered the trade. And yes, this is a long opportunity. Once this candle closes and we see this wick showing rejection, we can enter a buy and we put our stop loss below the low or away from the trend line. Anything around here is fine, or here is fine. And then we say we target 1:1.5 for a beginner. A beginner target 1:1.5, and please exit the market. If you're not a beginner and you know how the market works, you want to stretch it out and reach for the first point where the trend line started. That's the first place you want to reach. You want to stretch it out and reach from the first point where the trend line started. And guess what? Like that, exactly marking I think almost 4 checklists, we are in a buy trade and you can clearly see the market moving in your favor. But this alone, if you start here, let me tell you what will happen in your trading. 40 of your trades out of 100 will be winners and 60 will be losers. In fact, there are some days where 30 of your trades will be the winners and 60 will be losers. And you do not know which one. Your high probability is not on your side. You are confused. You're just hoping the market goes your direction. How we make sure, and of course, there are no certainties in trading. There are no guarantees, there are no predictions. And you will learn a lot about this when you move into SMC, when you move into psychology. You will know that the market is a king on its own and we can't tell it what to do. If you do this alone, you will make profits, as some of you have, but this alone will not show you or give you the profitability you need. You need what we call a directional bias. That's the first thing I teach. Now, let me go straight down into it. I've done a better introduction for that. Now, for directional bias, there are 4 ways to trade directional bias, to look for directional bias. Because I can't compress all 4 in one teaching, I will teach you the two main ways to do it, and they are equally as powerful. But first off, there are rules to trading. There are specific rules, excuse me, there are specific rules for trading directional bias because of how powerful it is. One of the most important rules for directional bias is that it must start from the higher time frame. Write that down if you don't, if you are with your note. And I hope you're not watching this at Netflix. You know I don't like that. Let nobody watch this like a movie. Write it down. I do expect the market to trade to this high. Oh, it's already there already. So let's see what happens with this. But pay attention to the class. Let me know distractors. The first thing is that you want all directional bias to start from the higher time frame. But this is relative to the type of trader that you are. Okay? So your rules is directional bias, but you want directional bias to start on the higher time frame. That's your first rule. I don't know why this is misleading. All right. So you start from the higher time frame. So when you start from the higher time frames, you will be able to get a sense of direction. But which time frame is high and which time frame is not? This is relative to the type of trader that you are, right? This is relative to the type of trader that you are. So if you are a swing trader, your time frames are from the weekly to the daily. Everything is fine now. So you start from the higher time frames, and if you are a swing trader, your time frame is the weekly, the daily, and just the weekly and the daily. If you are a hybrid now, a hybrid is a trader that trades swing trades and trades they trade swing trades and trade day trades. They hold their trades for like a few days. They don't hold it for more than 2 days, more than 3 days. If it gets to more than 3, 4 days, it's a swing trade. So they are hybrids. Most people are hybrids. Not everybody is a swing trader. Not everybody is a day trader, right? So most people are hybrids. Then for the day traders, your time, okay, for the hybrid, your time frame is the daily, the 4 hour. The daily, the 4 hour, this is where you want to use to tell you direction. Then for the day traders, you're using daily 4 hour and 1 hour for your directional bias. Write this down. Then if you are a scalper, you start from the 4 hour. You also look at the daily, but more significance is placed on the 4 hour. Now, you can argue this if you want. You can say I'm saying nonsense. You can, there are many people who are very, very good at technical analysis. I am telling you, if you want to trade the building blocks pattern in a way that works, this is the time frames you pay attention to when you want to use them. For a scalper, you start from the 4 hour, then move to the 1 hour. There are sometimes you would have to even make do with the 30 minutes as a day trader. Yes, as a scalper, rather. Now, long story cut short, the first rule and the most important when you want to do a directional bias is that you will start from the higher time frames. The second rule is stick with the trend. That's rule number 2. Write that down. Rule number 2 is stick with the trend. I will show you examples, of course. You know, I don't teach without examples. So you stick with the trend. But let me just write trend to make it easy. You write stick with the trend. You want to find the trend and then you want to stick with it. I will show you how. Because sometimes on the higher time frame, the market can be trending upwards. And then when you go to the lower time frame, you'll be seeing a sell setup. It confuses people, and this is why most people get stopped out. Then finally, what you focus on to the rules is that you want to be flexible. That's the third thing. Because some people are so rigid, and this is why they can't be profitable in trading. Some people are so rigid that if the market is going up, it's going up. They have no flexibility to say, okay, let me look at what the market is saying. They will stick to what they want in their head. And we need to, I can't wait to enter psychology class. That is the determinant of your success in trading. Technical is one part of the portion. There are people who, when they come into the market, they believe the market will buy. And because they believe the market will buy, once the market starts showing them that the setup has changed, I want to start selling, if they reject that notion and their brain, the thing about your brain is that it's so powerful. It shows you what you want to see. If intrinsically you want a buy to happen, the only thing you will see are things that tell you to buy. Now, if you're a day trader or a scalper, I want you to be very, very flexible. Not doesn't mean you should quickly change your analysis. No, I'm teaching you that you need to be able to allow yourself to look at what the market is saying based on preset rules I will show you, and then follow that. Don't force a direction. The market will tell you the direction, right? And then I think with that said, we can move into the 3 or the 4 ways to trade to picture directional bias. Now, the fourth thing I would say for this rule is objectivity. Now, in simpler terms, it means trade what you see. That's what it means. It means trade what you see. That's what to be objective. There is no subjectivity here. There is no, oh, it's trending up or it's trending down. You trade what you see and you go with the flow, right? So that's exactly what trade what objectivity means when it comes to this. The first way to trade directional bias is fundamental analysis. Now, for fundamental analysis is something, honestly speaking, I can't teach in one video. It's a lot. Uh, People have been asking, why is the dollar strong? I mean, it's obvious. The dollar, Trump had a very good communication with tariffs, and then boom, it's good for the dollar. I will not talk more, I will not say more than that because fundamental analysis is a lot, and it's an entire series. So, but you don't need it to be profitable in trading. There are many people who don't use it. So I use fundamentals and sentiment as a heavy confluence to tell direction. So, but there is the one that you can use, and this is the one I want to teach. It has to do with trend. Excuse me. I don't know why this happens a lot. It has to do with trend, right? You will be able to tell the trend based on the market moving external and internal. Don't get confused. The trend based on the market moving external and internal, and I will explain that. It's very simple. Based on the market moving from external, outside, to internal. And I explained this before. So let me go forward. Now, what does this mean? I will come back and talk about the second way. I will teach you how to identify the trend, but let me explain this. When you talk about external, internal, what does it mean? Now, if you've been trading smart money concepts or ICT, or you've been learning from the CEO, you would know that we're talking about liquidity. But I don't want to use terms that confuses anyone. I want it to be very simple. So it works this way. The market moves outside and then inside. It moves outside and then inside. It's not as smooth as this, but largely speaking, if you zoom out, this is exactly what the market is doing. Now, on the higher time frames, if the market moves inside based on a range, that's why it's called range. Which range, sir? The last range that you can see and mark with your fib. You don't even have to mark it. I don't mark it, but if you are starting, mark the range. So I will mark the last range from this low to this high based on what I can see. Once the market goes outside, it cuts outside. This was outside. Now it's outside the market. We expect it to snap back, to move back inside. Because we expect it to move back inside, the market was moving higher before, and I expect it to move back inside, this automatically means I should be expecting sales to come into the market. Does this make sense? But where are you looking at this from? You're looking at the higher time frames based on the type of trader that you are. Let me copy this. You're looking at a higher time frame based on the type of trader that you are. So you're not guessing, you're looking at it. And this is very common. Now, I will show you examples so you don't get confused. Now, what if I'm in a market scenario that does something like this? Okay, the market expands higher, drops lower, goes higher, and it's like this, and it's like this. How do I know where? All you are doing is looking for outside and inside. Has it gone out? Yes. Would it come back in? You expect it to. We all move based on expectation. When you come to your chart and you start from the higher time frame, the first and the most important question you should ask yourself is, where is the market at right now? And you answer yourself based on internal and external range. Where is the market at right now? Where is this market at? Then you look at the chart. Is it outside? Is it inside? If you know that, then you now ask yourself, where is it likely to go to? That's question number 2. Where is the market likely to go to? So where is the market at right now? Where is it likely to go to? Once you answer those questions, you're giving yourself, you're training yourself as to, okay, I have a sense of direction. You're training yourself as to, oh, I have a sense of direction. I know where the market is likely to draw to based on these questions. Because when you ask yourself, you based on the knowledge I'm teaching you, your brain begins to show you the pattern. You begin to see it. But if you don't ask yourself and you're like, show me the pattern, you will see the pattern, but you won't get direction. Let me give you an example based on what I'm teaching. So ultimately, this boils down to identifying the trend. This is why I gave you a rule. One of the rules says, stay with the trend. Now, I will go to, let's pick an asset class. Let's say Euro USD, because I like trading Euro USD. So let's look at Euro USD and let's see, let's say we are a swing trader. You are going to go to the higher time frame, which starts from the weekly. And what are you looking at from the weekly? Relative to where the market is right now. Where is the market right now? At where the market is before this weekly candle we are seeing a market that did, let me mark this, for relative to the last range, the market went outside, external range liquidity, external. And since it went outside, we now see the market selling because we expect it to come inside. It's a trend. The market, okay, let me use a simpler word. The market does what we call move one, impulsive move. If you learn trends, if you've not learned, go and watch the video I sent to the group on market structure. When it does that, it will retrace, move two, or phase one, phase two. When it moves up for phase one, we expect phase two to happen, right? So this is how the market works. Now, if this is phase one is the strong move in the direction of the trend. If this is phase one, then what is phase two? Phase two is what you call the retracement. Phase two is the retracement. So for every phase one, expect a phase two. Does that make sense? I think that's easier to understand. For every phase two, expect a phase one. For every phase one, expect a phase two. Phase one is the long, strong, powerful drive. Then for every phase two, expect a phase one to happen. Now, this is if the market is in a trend. And guess what? I taught you a trend trading strategy. The system does not trade ranges, it trades trends. So if I am in a phase one and I'm expecting phase two to happen, what am I going to be looking at? That's when you now go down to your lower time frames to find a market that trends to the upside that you can take advantage of to now see the market break a trend line to sell. I don't know if what I'm saying makes sense, right? So it's very simple. It's that simple. You are looking at outside, inside, outside, inside. Does it go out? Does it come in? If it's out, then I expect it to come in for a phase one. Now, what happens if I cannot see phase one and phase two? And this is what I'm seeing. Then you are in a ranging market. As a swing trader, this is a ranging market for you. And you are out of, if you zoom into a lower time frame, if you have been trading for a while, if you're a beginner, don't worry, the team is working on a beginner series. But if you zoom into the lower time frame and you're looking at this, when you go to the lower time frame, this is a downtrend, which means that you get the opportunity to day trade or to scalp. I'm talking to swing traders now. When you are a swing trader, what you are looking at from here is a market that wants to drop lower based on the movement of up, down, up, down. Now, if I now see a market that wants to drop lower, what do I do? And this is when I will now go to the 4 hour, to the 1 hour to look for a chart pattern. And guess what? On the 4 hour, you can clearly see a market that did a trend, a building block system, powerfully right there in front of you. I have no idea my trend line. You can see that. Do you see that I'm not blindly looking for patterns? While you are, oh, which pattern to trade? Oh, I've seen a trend line. I'm like, no, you need a directional bias first. When you have that, then you have something. That's exactly how this trend line or this building block system, we have 1 drive, 2 drive, 3 drive, 4 drive. Then we have touch 1, okay, touch 1, touch 2, touch 3, touch 4. Market breaks it. Does it give a fair value gap? I have to zoom in. But you get my point. It makes sense when directional bias is in charge. And if I come to the lower time frame and I don't find the trend, the building block system, what do? I leave it. I can't find my system. I leave it. I go to another asset class or I leave it alone, right? The market breaks out of this, completely breaking out, then retraces to previous support turned resistance. I think the fair value gap that was formed is this tiny one here. All right, so simply put, it's that simple. You're looking for a market that is trending. Market is moving up and down, phase one, phase two. When phase one has completed and phase two is forming, you want to see a situation where there is a building block scenario that tells you to buy. So ideally, everything I'm trying to say, if I'm going to narrow down and bring it in simple terms, I'm telling you to trade the trend. Now, let me show you a day trading system here with the same phase one and phase two I'm teaching. Assuming that you are a day trader or a scalper, and this is the 4-hour time frame, and you're trading up and down, you automatically know that from here, you are looking for buying opportunities. Anything like this that the market has to that starts to trend to the upside, it goes up, it comes down, it goes up. You're looking for buying scenarios, buying opportunity. So what would you do? So let me mark this. What you will start looking for from here before this place formed is any building block system from the 15 minutes. Now I've given your date, your time frames from the 15 minutes to the 5 minutes that gives you or that shows you a clear building block, a very clear building block. You did not decide to buy when you came here. You decided to buy from the higher time frame. This place is only showing you, oh, there's a building block here. You can trade it to the upside. Now, if you can't find one at exactly where you are on this time frame, you can go to the lower time frame, but there is one here for us. You now see how building blocks will now make sense. You will be more profitable this way. Now, this is the 15 minutes time frame. I'm not coming here to look for sell. Okay, when I see a movement, and some of you will come and say, the market is moving to the upside. I am going to wait for a market trend line this way. Somebody will say, let me mark a buy trend line like this. When the market breaks, I'm going to enter. And if you do that, you can see that the market just kept going up. So I'm telling you to stick with the trend. How will you know the trend? Look for the market that is moving phase one and phase two, outside, inside. Mark, now I will mark this trend line. From here to this point, I will mark it. Find the place where I have the most touches. I have one, I have two, three, and I have four. Then drive, I have one, I have two, I have three. That's a good criteria met. I have a tiny fair value gap there. Can you see that? Do you see when it makes sense? Hmm. Do you see how it makes sense? Now your trend and everything you're doing makes sense. I'll show you a trade I took on gold today. A sell on gold. I'll show you everything. Don't worry. So the market moved up, bounced in, and then where is my target? Your first target is the risk to reward ratio of 1:1.5 here. How would you know it's time to enter the trade? When the market dropped and you're seeing these candles, I think I've taught this. I shouldn't even be talking about entries. When you see these wicks, this rejection candle, that there is a larger wick compared to the body or an engulfing candle, you enter your trade. You target 1:1.5 or the most recent high that started the trend line. This is a very powerful stuff, right? So this is how you tell direction. Use the trend. Use the trend. When you use, okay, is the market trending? What does this mean? I'm repeating myself because sometimes repetition is what gets people to understand. When you see it over and over again, do I have a market that's trending up and down? Yes. If I find one early, the market goes out, I expect it to come in. It goes out, I expect it to come in. If I see this on any time frame, then the next lower time frames are my entry time frames. So somebody will ask, what time frames can I find this thing on? I don't understand why you're asking that question because what you are looking for is I'm looking for patterns. So I'm going to search 1 minute, 2 minutes, 3 minutes, 5 minutes until I see pattern, then trade it. No. The time frame that tells you direction is the first place you start from. If you are a trader, the trader you are will tell you the time frame to start from. Okay, so that's the second way to tell directional bias, outside, inside. The next way to tell directional bias is, I hope I don't confuse you when I say this, what we call the draw on liquidity. Now, I told you there are 4 ways, but I will teach 2 in this session. The first one is the trend, external, internal, outside, inside, was what I was talking about. The second way is what we call the draw on liquidity. And if you get this, this is powerful, right? You can use any of them. You can use them all together. You can decide to focus on one. That's also fine. All of them work. The draw on liquidity. And what does this mean? It's the same thing. It goes outside, inside. The reason I'm using this is because to others, this will matter. To some, it will not. So the draw on liquidity is the second way. What does liquidity mean? Anywhere where there could be stop losses or imbalances. Write this down. I can't type as much as I'm speaking, right? Because I don't want this to be too long. So either way, I'm talking about liquidity. How do I know where the market is going to go to? Look for the next draw on liquidity. What does this mean? Anywhere there could be stop losses. How do I identify where there are stop losses? I will show you. Or anywhere there could be imbalances. The market will draw to those places. On what time frame? Depending on the type of trader that you are. If you're a day trader, use the daily, use the 4 hour. If you're a scalper, use the 4 hour, use the 1 hour, even use the 30 minutes. It depends on the type of trader that you are. Before you look for chart patterns, I can't say this long, I can't say this too much, but I mean, I'm intentionally repeating it so that it gets into your head and your mind, right? Now, what does this mean? The market would go for places where there is resting orders. Anytime you see a market create a high or relative equal high, like this, the new high is not higher than the previous one. There is stop losses. There are stop loss orders there. So people will come and place their bets that if the market comes here and breaks out, let it keep going. Others will come and say, if the market comes here, stop me out. So because people see that area and people keep piling, so especially retail traders, they keep piling their stop losses, keep piling their orders, piling entries. What the market will do to you is that it's going to come down there, it's going to come up there and execute and open those positions. Why? Your order is there. And in order for them to sell or to buy, they need to drag price to where your order is and execute it. So let me move this so we can see. The way the market works is that it likes where there are people orders, and it goes there to take it out. This is what we call outside liquidity. Then there is what we call imbalances, where for every buyer there must be a seller, and if there is no seller, there lies an imbalance. So because of that imbalance, the market would tend to draw back into it. This is what most of you know as a fair value gap. If you don't understand this, don't worry. The beginner series they are working on will show you how to do it. So the market has imbalances, and every time the market is moving and is heading to an area where there's an imbalance, we expect that market to trade to that imbalance. Does it do that all the time? No. That's why it's called an expectation. We expect it to trade to an area of imbalance. What does this mean? I'll show you in the chart. The market will move outside and inside. This is the character of the market. Now, knowing that the market will move outside and inside gives us an edge to trade. It gives us an opportunity to trade. I will show you an example with the gold because I actually took a sell on the gold today. Now, let me use this. So gold sold off yesterday, and it wasn't a new story. Okay, my markup is still there. I was expecting to sell the gold from the higher time frame, right? I sold the gold. You know why? Everything is clear. But let me show you why from a direction perspective, not just a from a direction perspective. The market had done outside, right? It had done external, and I expected to. Let me delete these things so we can see. Okay, so the market had done external, right? After taking out all this high, it was a trend, it moved up, but trends don't go up forever, so it broke down, which means the trend had changed. It started to sell. The market started to break down. If you look at the 4 hour time frame, you clearly see that the market is trending to the downside, lower lows, lower highs, for those of you that understand how trends work. So this is a bearish market. If the market is making lower lows and lower highs and is moving this way with full force, this means gold is bearish. Gold is not a bullish market for swing traders. If you are day trading, scalping, you can find short-term trades and then blah, blah, blah. But if you are a swing trader, you are selling the gold. The market is trending to the downside. So if as a swing trader, you now see a chart pattern that says to buy, are you going to buy? No, you're not going to buy because your higher time frames, your daily, your 4 hour, your weekly, they are selling. Where are they going to? There are people stop losses resting below this low. And that's where they were dragging and pulling themselves to. Look at another area of this low and this low, they look alike. So this low and this low, since they look alike, the market will draw to it. Can you see that? Boom. After the market does external in form of stop losses, it goes back to do internal. What is internal? Can you see this fair value gap? That's an imbalance. That's internal, yes. That's internal range liquidity. So the fair value gap is what it goes. Go and look at your chart. Do your due diligence. You'll find out that every time the market expands outside, it looks for inside. And every time it expands inside, it's looking for outside. It moves back into the fair value gap. So since it moves back into the fair value gap, this is my opportunity to do external again. It did external and now it has done internal. If you trade trends, the first way I said, it comes outside and goes back and does inside. You can say phase one, phase two. Now, from here, anything that looks like a trend line to sell from is what I will be looking at for a swing trade. And I had that clearly, I think on the 1 hour, yes. So on the 1 hour, we have a trend line. Do you see that I'm not marking? I wanted to sell from the daily and the 4 hour. So the daily and the 4 hour gave me the opportunity to want to sell. All I had to do was look for an opportunity to mark a trend line. Now, if I don't see this, I would not have a trade for swing trading, and that's fine. My setup does not show every day. I am patient. This is the sell. The market broke completely, selling off based on the trend line. Now, do you see that this isn't guesswork? You're not, oh, I see a trend line for a sell and I enter. You are selling from the higher time frame. If you're a day trader, let's go back to the daily time frame. You want to clearly be looked, in fact, if you're a day trader, use this liquidity concept a lot. This inside, outside. The market external does external range liquidity outside, right? What would it do? It will do inside. If you're a day trader, you'll be looking for opportunity where the market will come inside. How? Since you expect, because it can decide to not come inside and go, but if you expect it to come inside, you are going to now go to a lower time frame and look for downtrending market like this on a lower time frame. And when you see a trend line, mark it. When it breaks above the trend line and retraces, then you buy. Then you place a buy trade. But if you don't see this, you don't have a trade. But you don't come to the lower time frame to be looking for sales. I start here. Finally, once the market expanded, and it does, I came to the market during the New York session, so there was a big green candle. In my head, it has done internal range liquidity. I moved to the 4 hour time frame. After doing internal, I expect external. You see this sell that is happening for a day trading perspective. You wait for the market. Where did it trade into? A fair value gap. As what? As internal range liquidity. Let me mark it with this so that it will be clear. You see this? It's there. I'm not making this stuff up. It's there on the chart. Do your due diligence and practice. It goes out and comes in. When it goes out, what does it go for? Stop losses. Stop losses. This low and this low, there are stop losses resting there. It goes into those stop losses. After dealing with the stop losses, it will return to imbalances. When you use this on the higher time frames, this returning to imbalances, then what am I looking for? For a day trader, I will go to the 5 minutes, 15 minutes, wherever I see my setup most clearly, and then I will look for anything that looks like a trend that is selling, a trend that is buying because I want to sell. So I will look for a buy trade scenario and sell against that. Now, the most clear one I can see for a sell is this. For a buy is this. It's not too clear, but I could mark this. And you mark this. So we have a market that does one touch, multiple touches here. It does a wick, that's fine, because wicks can color around, wicks can come out, that's fine. And then what does it do? It breaks. When it breaks, it retests. When it retests, I'm looking for weeks, 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 rejection, rejection, rejection. And on that note, there is a sell opportunity here, and I exited when the market did external range liquidity. I can share my X next to you if you want to see that. This is the trade I took for a gold today to sell from this high where the market, I think I entered around here, where the market was weakening, and then to sell to take out external range liquidity. But the sell was not because I'm looking for, because somebody will come and say, let me mark this trend line. If it breaks out, I buy. No, you're looking for a sell. If you came in the morning and you're looking for a buy, yes, you must have gotten the opportunity for a buy, because when the market does external, it will do internal. But ultimately, in a bearish market, you look for sales. Now, if I was to round up in simpler terms, because I want to wrap up the session now, and if you're confused, go back and watch the video. Repeat it 3 times. Repeat it 50 times if you have to. Write down your questions. Write down your questions. Write down the places that confuse you. Write down the things you want me to sort out, and then you can ask it when I give opportunity for you to ask it. But you must practice. You see people practicing in the charts. They are practicing it. They are being diligent with it. And you wonder why they see results. Let me tell you, this is not 100%. But when you do this often, you had a feedback from Mr. I've forgotten the name now, something from South Africa. And he's saying that this is actually helping his SMC concept. Others say they can now be confident that they have a technical system. Many people still trade, some people even trade in live, right? This works in currencies, it works in gold. But for gold, I want to teach risk management first, because gold is a beast. So when I teach risk management, you can trade gold as much as you like, following what I teach. Then you can use this on any asset. I don't know about the derivative because I'm still testing it there, but anything that is universally traded, you can use it on it. Now, what I'm saying in the most simplest terms is when you start to trade, before you look for the building block trading system, start from by asking yourself, where is the market right now on a higher time frame relative to the trader that you are? When you ask yourself that question, the next thing you will do is to say, where is the market going now? And that would depend on the trend. I'm being very simple. The trend. So you are using the trend. So if the market is in a buy trend, you are looking for buying opportunities only. So if you start from the daily time frame and you see the market trending upward, you are only looking to buy the market as a swing trader or as a day trader, right? So if you are a long-term trader, start from the monthly, the weekly, look for a trend. When the market is trending, look for buying opportunities. Don't be looking to sell. Now, if I come to the 4 hour or the 1 hour and I'm a scalper, what am I looking for? Even the 30 minutes, look for the trend. When you find the trend, then that is when you now move to a lower time frame, the 15 minutes, the 5 minutes if you're a day trader, even the 1 minute, and look for the building block system, the building block strategy. So this is showing on, let me say, this is showing on the daily time frame. Or let's say we are looking to scalp. So let's use this is showing on the M30, the 30 minutes time frame, right? This is showing on the 30 minutes time frame. Then what am I looking at? You're going to look for, or you go to a lower time frame to the 5 minutes, and then what you look for on the 5 minutes is a market that is selling. You want to see a market that is selling so that you can mark, excuse me, so that you can mark your trend on it. You can mark your trend lines on it. So I will mark a trend, and it's not just about marking the trend. Check the checklist. The building block system is a system with checklists. 1 drive, 2 drive, 3 drive, 1 touch, 2 touch, 3 touch. Then you wait for it to break. When it breaks, because it's an opportunity to join the trend. When the market completely breaks, look for a fair value gap. Will it always give a fair value gap? Apologies, I absolutely do not know what is going on. Look for a fair value gap. When the market breaks and gives a fair value gap here, if it doesn't, Look for previous support turned resistance, or the trend line itself can do the job. The market hits the trend line, look for a rejection candle or an engulfing candle. I prefer the rejection candle, where the body is smaller, much smaller than the wicks. The wicks should be larger. And then you have a buy trade. Did you start by pursuing chart patterns? No. Starting from here, then you went to a lower time frame. You don't need to be confused as to time frame. Start from the 15 minutes. If you don't see it from the 15 minutes, go to the 5 minutes. If you don't see it from the 5 minutes, go to the 1 minute and look for it. With this, if you combine direction and then you combine this building block system and the entry pattern I have mentioned, where you will look for your rejection candle, you will have a complete system. This is a complete system. There are many other parts I can't teach in one single mentorship, but this is enough. This is more than enough. There are other things, when it comes to a market maker model, there are a lot of things, but this is enough to get you started. Do I make money all the time? No, I take losses. I take losses. And sometimes I have losing streaks. But do I eventually come out profitable? Yes, and I will send a video to show you something like that in the group later on. I'll show you my equity curve. I do come out profitable when I trade this. But what else is missing? If you can master your technical system, then you will now start working on your psychology. If your psychology is the problem, from the next teaching, you need to learn how the market behaves so that you can be able to develop patience, because the market has a life on its own, right? So I want to wrap up this session. And this, if you did not hear anything I said before, just hear this one. This is the most simplest way to tell direction. If you have been studying smart money concept, then listen to the first one, to the second one, internal external range liquidity, liquidity as stop losses, liquidity as imbalances. But if you don't know all those things and it's confusing you, just find a trending market and look for building blocks on the lower time frame of the trending market and trade it. Find the trending market, look for the building blocks on lower time frame and trade it. What does this mean? Let's look for a trending market today. So let's say we go to the NASDAQ, for example. I'm using any asset. Why am I doing this? So you know that any asset can work. So let's use the NASDAQ. Okay. So this is the NASDAQ. Let me remove this. Excuse me, we were waiting for this. So, and the market sold today, and now we have a market that wants to buy. But this one is based on the chart pattern. We are not looking at it. We'll go first to find direction. Say I want to scalp this market. I will first of all look for the trend. If you're scalping, I said you should start from where? 4-hour time frame. So I will look for the 4-hour time frame, and then I will look for the trend. What is the market doing from here? It's supposed to be moving up, but this upward movement and this big scary candle is confusing. Let's go to the 1-hour candle and let's see. That's why I said you should be flexible. Okay, so when I started the day today, looking at this, let me mark this. I expected the market to buy from the 1-hour time frame because the market seems to be making a higher high than yesterday. So from today, coming into the market before this big move, I'll be looking to buy the market. This is a trend because I didn't see this part happening, right? I want to scalp. I want to put this as to when the day started. So the day started here. Good. So this is a buy trend. This did not happen yet. You're going to be looking to buy as a scalper. What would you do? You move to a lower time frame, to the 5 minutes, to the 1 minute, and all you're looking for is a market that shows you the building block system. And until you find it, you don't have a trade. So you wait. Yes, you wait. Oh, is this it? Is this building block? No, no 3 drives. You wait. Okay, we have something that looks like it here. Let me see. Let me use this as an example. We have 1, we have 2, and then if we were to mark the trend line, would this be possible? We just have 2 touches and it's not enough. But I will use this for an example. But this is not a trade. But let's use this for an example. You wait for this. So when the market gives this kind of scenario where, okay, since I'm looking to buy, I'm going to be looking for an opportunity where the market would break a trend line. Okay, now we have something. One test, two tests, three tests, but the drives are not the same. When it breaks the trend line and returns to the fair value gap, here we have a buy. But this is not an ideal scenario, so you will wait. Exactly. You will wait for it to show a scenario where it says, I am going to be selling. When it gives you that sell, then you buy. When it doesn't give you that sell, okay, now we have one. Before the drop, we have a market that sold. This gave an opportunity for a buy. Clearly, do you see that you're not blindly looking for chart patterns? You know that I'm bullish based on the higher time frame until it changes. That makes me look for this. And when I see this, I'm interested in a trade. We have one test, one drive, not too much, but another test, another drive, another test, another drive. When the market breaks out, look at this. Let me zoom in. This is a random trade, by the way. I just picked it. Do we have a fair value gap? No. But do we have the market returning to the trend line? Yes. Do we have a rejection candle? Yes. Is this a trade? Yes. Can you see this? And where does the market go? Where is your ultimate take profit? If you are not a beginner, your ultimate take profit is the high that started the trend line. Sometimes it doesn't get there, but sometimes it does. Entry is here. Now somebody is saying, can I enter here? The trade is already done. Once the market touches or clears that trend line, the setup is ended. You have made use of the setup. It doesn't exist anymore. Your pattern is your entry. Once you find it, like it's there. Stop loss is below the most recent swing low. Take profit is above that high for a longer term trade. This is a day trade. This is a scalping movement. You waited. Did you see anything here that gave you the opportunity to trade? No, not really. But when it came and you waited and you are good to go. So this is exactly what I'm teaching. Now, if you have a question, if you're still confused, that's fine. Just write it down and we'll get back to you. When the market started to sell powerfully, and changed the entire game for the market. There was a news event though that caused this Nasdaq to sell. But you see where I started from? You see that I started from a higher time frame looking to buy. I saw an opportunity to buy. The trade completed itself. It had been done with the buy before this move happened to the downside. Let me give you one more example. Say we're trading, let's pick a random asset that I don't even focus on. Let's say the Euro JPY, because the concepts are universal. Let's say the Euro JPY, we go to the Forex asset. Say I want to day trade, where will I start from? I will start from the 4-hour time frame. And what am I looking for? A trend. Before this powerful move to the upside, the market was selling. It's a sell and it's moving to the upside. I will put my, I will put the horizontal bar from where the market started to today. I think it was around here. Wednesday, right? So you're looking for a sell from a lower time frame before the market shifted. Why am I looking for a sell? The trend is clearly bearish. But if you trade smart money concept, you also know that once the market has taken out a low for a swing trader, this is a swing trade. The low is taken out. Where is it going? It's going to go inside. What is it looking for? Fair value gaps. Are there any here? None. Where's the next fair value gap here? Chances are, if you trade the euro yen, I've just given you a place to pay attention to. The market could likely draw into these levels. There are multiple fair value gaps there. This is the first one, so you want to mark it and observe to see how price would react around that, because that's what calls price to it. In fact, just traded into it. Exactly. I'm not making this. What I'm teaching is there on the chart. It took out the low, it traded into the fair value gap. If you know this, you'll be looking for buying opportunities on the way to the fair value gap. Once the fair value gap has been traded into, when the market starts to turn, it's going to target fair value gaps, fair value gaps, fair value gaps. Or if it takes the fair value gap, it will go to the low. Everything is objective. Let's go back and look for the sell. Now, on the, excuse me, on the lower time frame, before this market did this big move to the upside, you would be looking for a sell, right? So why would I be looking for a sell on the 5 minutes or the 1 minute? I'll be looking for any opportunity where there is a trend line to the upside. And once that trend line is broken, or once the building block pattern, because it's not just a trend line with many moving parts. So let me call it for what it is. We're looking for a building block system. Once the building block system is found, I'm going to look for an opportunity to join the move. So can I find one here? No, not really. Let me mark this one. This is the only one I can see. And if you can't see, you let it go because you get stopped out. Does it do 3 touches? No. So this is just, okay. We have 3 touches. Let me zoom in. Okay, I think this class has gone on for more than I wanted it to. Now, this is a scalp trade. We have a market that comes once, doesn't really come twice though. Well, let me adjust the trend line. Okay, 1, 2, 3. How many drives? We have 1, we have 2, we have 3 drives. Where does it break? Here. Then you see the fair value gap? Yes. Fair value gap, hold low. And that's previous support acting as resistance. There's a tiny fair value gap here. Train your eyes to see these things. Train your eyes to see them. My eye jumps to them, right? Train your eyes to see them. You see how the market is reacting at the fair value gap? Now we wait for a rejection candle or an engulfing. We get an engulfing here. This market, this black candle completely covers the green one. And then the market trades up again. If you're waiting for this, you can enter the trade here. Where do I exit? Stop loss is here, below this low. That's your main target. Whereas this is a scalp trade, so the market kept going down. That's none of your business. That's absolutely none of your business. You chase it, you get slaughtered. You put this here, then you put it above this high because that's the most recent high, and then you target the low. We have a risk-reward ratio of 1:7. That's enough for a scalp trade. You're done for a scalping scenario. Is this random? Are you seeing me jumping up and down looking for chart patterns? No, I wait for direction. Right? So you can try the chart pattern approach if you are trading a higher time frame. But for this scenario, you want to wait for direction and then you want to go into it. So with this said, we'll wrap up the session. If you're confused, go back and watch the video, watch it again. And I think we have 20-something people on board. I just want to say thank you for showing up. Your diligence will pay off eventually. What you're doing for yourself will pay off eventually. And yeah, if you are in the group, please give us a shout out to when I open the group for people to respond. Give us a shout out and also make sure you subscribe to the YouTube channel to encourage the guys. And at the end of the day, if you have any question, you can always send a message to the group when it's open. And yeah, if you're using this and you're seeing it work, wait till I teach you psychology. By the time you blend the both of them, you learn how to take losses, you learn how to take wins, how to win when you're winning, you learn how to be patient. Most of you are afraid to trade, and it comes from the fact that you have been burned so many times and you don't even trust yourself anymore. It's an emotion that can be managed, and we'll deal with that in the next class. And this building block, this consistency will get you faster to where you ever want to get to than any other thing else. So with that being said, thank you so much for joining the class. We'll get feedback from the group. Cheers, and I will see you in the next session.